The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Welcome to Squawk Box. I'm Karen Cho with Sylvia Amaro in Brussels. These are your headlines. President Trump pauses some tariffs on Canada and Mexico, backtracking for a second time this week while promising the decision has nothing to do with the stock market reaction.
There are no delays at all. No, nothing to do with the market. I'm not even looking at the market because long term, the United States will be very strong with what's happening here.
We'll speak to the U.S. Treasury Secretary at 12 GMT. Tariff whiplash takes a toll on markets with tech leading losses as Wall Street eyes up its worst trading week of the year so far.
EU leaders agreed to new defense spending measures, but opposition from Hungary blocks unanimous support for Ukraine. The president of the European Commission says the bloc is stepping up.
History is being written. We are coming out of this European Council very determined to ensure Europe's security and to act with the scale, the speed and the resolve that this situation demands.
Chinese export growth slows more than expected as US tariffs hit, while imports see their sharpest fall since mid-2023. And Bitcoin falls as much as 6% as Trump's crypto executive order disappoints some in the sector ahead of a key summit at the White House. I think it's fair to say we've had action on every front this week, and as a result, stocks, bonds, foreign exchange, all moving in tandem. The American president is certainly disrupting forces when it comes to the trade side and Canada, Mexico to China, and of course defence. And we've seen the Europeans step up their commitment to defence and fiscal spending coming through in a big way. So lots of moving parts and having a dramatic impact on assets this week. The latest, US President Trump has again backtracked on his trade tariff strategy, announcing a 1-month reprieve for Mexican and Canadian goods that fall under the terms of the USMCA trade deal that he signed off back in 2020. A White House official told CNBC that about half of Mexican imports and 38% of Canadian imports are covered. The climb down caps a volatile week after the US leader imposed duties on Tuesday, sparking a trade war with America's neighbours. Trump's erratic trade policy, though, has sparked volatility across markets, with Wall Street now set for its worst week of 2025. The president was asked about the market fallout and whether investors were spooked by tariffs.
A lot of them are globalist countries and companies that won't be doing as well because we're taking back things that have been taken from us many years ago. We've been treated very unfairly as a country. We protect everybody. We do everything for all these countries. And a lot of these are globalist in nature. You know, they have, if you're outside of the United States, you know, it's going to be a little bit different. We just weren't treated right. We were ripped off as a country. I've been saying it for a long time.
Speaking to CNBC, Commerce Secretary Howard Lutnick dismissed concerns over Trump's trade policies, saying he backs the president's approach.
The president is focused on rebuilding America, and you are going to see growth in America. You're going to see an interest rate, when we balance the budget of the United States, you're going to see interest rates drop 1% or more. You're going to see the stock market explode. And if it doesn't do it tomorrow, that's because people just don't understand that they should be betting on Donald Trump. If I were them and I were your viewers, I would understand the long-term trade of Donald Trump is you bet on him and he is a winner and he is going to win for America.
Long-term trade was the message there. Important, I think, for the market that's been reacting, at least on a short-term basis. Now, the US trade balance has posted its biggest deficit since records began in January at $131 billion. Imports surged 10%, driven by consumer and industrial goods, amid front-loading ahead of President Trump's tariff rollout. Now, Treasury Secretary Scott Bessent defended the White House's tariff strategy, saying access to cheap goods is not the essence of the American dream, adding that the designers of multilateral trade deals have lost sight of this. The Treasury Secretary will join our US colleagues today ahead of the non-farm payrolls report. That interview is coming up at 12 GMT. Well, let's take a look at those US markets that have been roiled by the tariff news. And what we had across the board yesterday was a pullback, even with some carve-outs. And don't forget, up until yesterday, the market had been looking at hopes of negotiation still and perhaps seeing a bounce back on markets. But in fact, what we saw yesterday, markets still recoiling as we had concerns still lurking in the system. So the Dow, the S&P, NASDAQ all trading down. The NASDAQ in particular down 2%, and correction territory is the level we got to in session for the trading week, down 4% alone. So fairly sizable moves just in one trading week. Most negative stock yesterday, it was Nvidia. So again, we are seeing individual stocks that have been high flyers, in particular hard hit. But don't forget, yesterday also coincided with news that the Chinese had come up with even more technology that could have a knock-on effect for the likes of Nvidia. But you could see across the board, we were trading down. For the week, this is how we look for the markets. As I mentioned, that 4% down for the NASDAQ. In the same vein, 3.6 odd off the S&P 500. Europe versus the United States, and what has really emerged have been questions around US exceptionalism. As we started out the year, the markets were looking to diversify, but through US assets, which was just extraordinary. So very little bid in the markets for Europe. That is not the case anymore. We've moved a long way as a result. This trading week, how have we looked? Well, you can see some of the negativity has caught up with Europe, and don't forget there are concerns that Europe could still be next when it comes to tariffs. The ECB also alluding to the impact of that tariff uncertainty yesterday on investment. So that is a feature in the backdrop. But that said, we've had the fiscal spending from the Germans, more defence commitment, and Europe dedicated to doing more as it talks about some of the counterweight that it can have here versus that US tariff and security threat. Pivoting to Asia, it's been a decent old trading week across on those markets. Take a look at what we've seen across on Japanese stocks, for instance. That has been a decent trade over the course of this week. Today we are seeing some caution, though, back in the mix, and Japanese stocks trading down 2.3%. They were having a decent old trading week until today's moves have caught up with them. Elsewhere, stocks out of Hong Kong. Again, it's the AI technology news that the Chinese are bringing to the market. First up, it was DeepSeek a few weeks ago. Now it's Alibaba, and that has certainly moved the needle on the markets there, as well as some of the consumption priorities that the government is now talking about. That has been a point that the markets have picked up on this week. But as you can see, Friday's session, we're just going risk off, and it's about safety trades today, all ahead of a data point too. Non-farm payrolls later on today, as you've now got a market talking more about stagflation as the macroeconomic backdrop. Well, let's come to security, as President Zelensky says Ukrainian and US delegations will meet in Saudi Arabia next week. In a statement on his Telegram channel, Zelensky said Ukraine would work constructively for a, quote, quick and reliable peace. He is scheduled to meet the Saudi Crown Prince on Monday ahead of the negotiations. EU leaders have backed a proposal to boost defence spending across the bloc. The European Council called for the Commission to urgently enact the plan, which could mobilise as much as 800 billion euros. But leaders could not reach agreement on Ukraine, with Hungarian Prime Minister Viktor Orbán opposing language pledging more military aid and setting out conditions for peace talks, text that was instead issued by the other 26 leaders at the summit. Now, the Commission President Ursula von der Leyen said the bloc's new defence spending plan comes at a crucial moment.
Today, history is being written. We are coming out of this European Council very determined to ensure Europe's security and to act with the scale, the speed and the resolve that this situation demands. We are determined to invest more, to invest better and to invest faster together. From Paris to London to Brussels, we have shown that we are willing and able to step up our joint efforts and to coordinate effectively. Fact is that Europe is facing a clear and present danger.
Well, let's get out to Sylvia. She joins us live from Brussels with more. What we're hearing is that the Europeans are very keen to showcase that they have defence capabilities. But again, in every crisis, there's always one or two members of the mix that are thwarting efforts to proceed. So just walk us through some of the obstacles that Europe is still facing with this massive defence plan.
So we have the 27, the EU together, saying that they will be spending more on defense. And yesterday, the leaders said they gave their green light to the latest measures announced by the Commission earlier this week. So the ball now is in the court of the finance ministers. They will be meeting here again on Monday and on Tuesday to start those technical works to develop all of those measures announced by the Commission earlier this week. And that, of course, includes 150 billion euros in loans that the member states will be able to use so they can spend more on defense. That's a positive. And that is indeed, as von der Leyen said there, historic. The EU, for its whole history, has been focused on creating peace. This is a moment where, for the first time in many years, we're hearing them talking seriously about stepping up defense spending. Now, separate from that, the other topic on the agenda for the leaders yesterday was further support for Ukraine. They were discussing how they can provide security guarantees to Ukraine in a moment when they actually can sit down and eventually discuss peace negotiations too. The problem there was that Hungary was against saying any sort of new words that would mean support for Ukraine. Yesterday I had access to a letter that the Prime Minister of Hungary sent to the President of the European Council, Antonio Costa, where he highlighted why he does not believe this is the right approach. In the words of Viktor Orban, he said that the European Union should follow the example of the United States and actually enter direct discussions with Russia in order to guarantee a ceasefire. But of course, the other 26 members of the EU disagree with that language, and so they, to some extent, ignored Viktor Orban, and they came up with their own communiqué in where he highlighted support for Ukraine. Ahead of the meeting, we have a chance to hear from the President of Ukraine himself. He came to this meeting. Here are the words of President Zelensky thanking the EU leaders for their support.
I want to thank all our European leaders, first of all, and for such signal, strong support. Discuss on strong support from the very beginning of the war and what's been during all this period and last week. You stay with us, and of course from all the Ukrainians, from all our nations, big appreciation. We are very thankful that we are not alone, and these are not just words, we feel it. It's very important. You made a strong signal to Ukrainian people, to Ukrainian warriors, to civilians, to all our families, and it's great that we are not alone. We feel it and we know it. Thank you so much for everything, and signals to increase our production and signals to, with the new program, to increase the European security. That's, I think, the great decisions.
But let's take a step back and look at all of the events that we have witnessed this week. We also heard from the French President, Emmanuel Macron, saying earlier this week that he was actually willing to use French nuclear weapons to protect the continent. So I asked a couple of leaders yesterday how they felt about Macron's suggestions.
It's a very interesting idea. Nuclear umbrella would serve as really very serious deterrence towards Russia. And it is very important to use this opportunity, all opportunities to increase our resilience, and especially in the eastern flank, because eastern flank is exposed to different kind of threats, and this is my idea, to focus more on the eastern flank, because we are exposed to hybrid attacks, we are exposed to the sabotage of critical infrastructure, illegal migration and other threats. And you know that sometimes it's not so easy to have the common border with aggressive states like Belarus or Russian Federation. but we do our best and we need the assistance of our partners.
We have not decided about that, and it just happened that there has been an announcement from President Macron, and it needs time to decide and probably to have some discussions in our country as well, because it's something new. But we see as an opportunity to discuss, but it's really too soon to give some real answers to that question.
So when it comes to the plan and the ideas of the French president, that is still too early, in the words of those leaders, to assess and how they are likely to do that or not. But Karen, the big takeaway at this stage is that this is no doubt a historic moment for the EU. We are no doubt starting a new chapter in European politics.
It does certainly feel like it is an exciting new phase ahead. Thank you so much for that, Sylvia. Coming up on the show, it's Jobs Friday. With February's NFP print due in a few hours' time, we'll take a closer look at what to expect. Plus, President Trump signs an executive order establishing a Bitcoin reserve ahead of a crypto summit at the White House. And following a widely expected ECB cut, don't miss our conversation with the ECB Governing Council member and Bank of Portugal Governor Mario Centeno. That is coming up at 7:45 GMT. US President Donald Trump announced that French shipping firm CMA-CGM will invest $20 billion into the US economy. The company is planning to build shipping terminals and expand its logistics network, creating 10,000 jobs. It comes as Trump reportedly prepares to impose fresh levies on ships linked to China when they call at US ports. A tariff uncertainty is weighing on Chinese trade flows after export growth came in weaker than expected in the first 2 months of the year, up 2.3%. That was less than half what analysts had penciled in. This as imports sank by as much worse than expected 8%, way down on December's 1% uptick. The US non-farm payrolls are expected to have risen by 170,000 in February, according to Dow Jones, with the unemployment rate set to hold firm at 4%. Average hourly earnings are seen rising 0.3% on a monthly basis. The February jobs report could be the first one to show the impact of Elon Musk's Doge agency. Steve Leisman has more on what to expect.
Announced layoff by employers in the United States in February surging by 245% to the highest level since the pandemic, with the Trump administration's efforts to reduce the federal workforce playing the biggest part. The outplacement firm Challenger Gray and Christmas saying that announced February layoffs, not actual layoffs, just announced ones, rose to 172,000, up from 49,000 in January. It's the highest monthly number since July 2020 and the worst February since 2009. It was a mix of layoffs from the government and the private sector, including government shedding 63,000 jobs, including federal workers and private government contractors, retail adding in 45,000, likely hit by cold weather, and tech 22,000, with HP, Meta, and Workday among the tech giants that announced February layoffs. The Doge impact was the top reason cited for job cuts, followed by market and economic conditions and bankruptcy. The bulk of government job cuts are likely too recent to show up in the February jobs report. Workers won't be counted as unemployed until their severance runs out. But roughly 30,000 federal workers leave their jobs every month in a normal month, so the hiring freeze announced by President Trump on day one of his presidency could mean vacated jobs won't be filled. That could create some negative numbers that end up dragging down the headline jobs number. Evercore ISI, in a research piece, suggests total job losses from the effort to reduce the employment Doge could be as low as 50,000 this year if the government eventually gets back to hiring in the back half, or as high as 660,000 in a worst-case scenario created by what it calls Doge policy uncertainty. They said Doge-related uncertainty over contracts and grants could have an additional paralyzing effect on hiring at employers exposed to these funding sources or in need of regulatory approvals from agencies that are themselves paralyzed by Doge review. Most forecasters are settling on a midpoint between 250,000 and 350,000 for total federal job losses, or roughly 20 to 30,000 a month, a noticeable number. The economic impact ultimately will depend on whether the private sector finds jobs for these workers and private sector job growth overcomes the drag from the federal side. Steve Leisman, CNBC Business News.
Terrific piece of reporting there from Steve Leisman. Let's get to Alex Morris, CIO at FM Investments. Alex, so we just heard of that package from Steve focusing on the impact of DOGE from the government agency review. But the other big feature is tariffs, and we've now got a market concerned about stagflation. So jobs today feel like another piece of the puzzle on just how the economy is holding up. How are you perceiving jobs and the relevance here for what the Federal Reserve is going to do?
Well, controlling inflation is really hard anyway, despite how easy Jerome Powell and Governor Bailey may make it look. But what we're really going to get today is our first report card of the largest take-private event in the history of certainly America, but maybe the world, is how do we try to privatize and change how the American economy works and how the American economy fits into the global order. Well, what we see tariffs doing, and we remind folks, is when you hear tariffs, think inflation. When you hear tariffs are delayed again, think more inflation. And when you hear tariffs aren't going to cause prices to move in the way that you expect, think Japan. And all of that adds to this broad market anxiety that makes it really hard to actually control inflation and actually drives prices up as suppliers drive prices up in anticipation of inflation. So you get to this weird loop where it almost doesn't matter at this point. It's just been the on again, off again story that's going to drive prices higher and might drive inflation out of control before anyone has a chance to stop it.
So where does it leave the US Fed as it also waited out for this data piece? I mean, we've got the market saying about 77 basis points of easing priced in for this year. Do you think the Fed's going to be able to cut in this type of environment if inflation is going to be coming back?
I don't think the Fed's going to be able to cut anytime soon. Fed Waller was out just yesterday saying he doesn't see a need for a cut now. I think if the Fed had its druthers, it would sit on its hands all year. And if it was allowed to, it would just stop showing up for every press conference it had and just wait until December when it would be aspirational to deliver a token cut. Now, there is the other side, though, that maybe the Fed has to come to the rescue before then. That's generally a bad case because now we're talking about a growth story. And I think folks look at it and say, well, it's not inflation, it's not jobs. You stimulating growth is good. But if the Fed has to drastically reduce rates to stimulate growth, that's because things have gone terribly wrong. And that's an outcome no one is looking for.
We were playing a comment earlier from Lutnick, who was talking about jobs coming back to the US, that investment is happening. He pointed out to the Apple case about the iPhones have been made in China and elsewhere, but now Apple's investing in the United States. But I wonder what that's going to mean for the job market and for the economy, because it comes at a time when we have AI and robotics. And if companies are making a decision to invest not in China and the United States, are they going to do it with automation that's going to give them certainty around labor costs? What do you think the potential is for all of these so-called investments coming home to the United States?
Certainly, it's a massive potential, but it doesn't happen overnight. Layoffs are real. They happen today and they hit the payrolls 6 weeks later. But that sort of re-engineering of a business, of its entire supply chain, of how it thinks about hiring and labor 1, 2, 10 years out, those are the types of things that take a very long time to play out. So although they make good headlines and may make it easier for those companies to work with the administration, they don't practically help the average consumer today or tomorrow. And I think that's where folks need to really pay attention. We can raise prices and change strategy far in advance of our ability to actually have those numbers come through to the real economy.
Alex, somewhat telling for me was how the markets reacted yesterday, even with carve-outs for allies across the border. We're talking about Canada, Mexico, part of the USMCA. So the market had been hoping all along there would be some form of negotiation around tariffs, and they got it, but still the market sold off. Is that saying this uncertainty is really now just catching up with markets, so the risk-off moves are going to remain here for a while?
Yes, Karen, I think it is. I know we've talked before about the stock market being an expectations market. And so the antidote to, that sort of anxiety is clarity. This is far from delivering clarity on a regular basis. It's just more volatility, more uncertainty, the fear of the next time we won't be able to find a negotiated solution, or it won't be politically expedient to push kick the can down the road another few months. And I think that's what you're seeing in the stock market. You saw it also in the cryptocurrency market after the strategic crypto reserve was announced and didn't seem to meet expectations of the crypto market. So you're starting to see all of these factors of it's very easy to make a headline that makes some percentage of the voters out there happy. It's very hard to get one that actually can drive through to all the financial markets right away.
Alex, what jumps out to me is not just the stock market move stateside, but the dollar's down. You've got other currencies that really struggled for years to find a floor, now bouncing strongly, safety assets back on, and money pivoting this reallocation away from the United States to other markets like Asia and even Europe that had been left behind at the start of this year. How long do those trends go on for?
I think you're going to see the dollar continue to weaken throughout the year. That's really a statement of Donald Trump's policy. In season one, it was very much a weak dollar policy. Most of it was achieved through narrative and jawboning the dollar lower. This time around, it's been more of a bazooka-like approach, really focused less on the dollar, more on the 10-year rate in the U.S., perhaps with the hope that that will drive the ability to issue mortgages far up and for folks to refinance at a lower rate. But practically speaking, the shift away from dollar dominance and dollar strength is really one of just American exceptionalism dwindling under the Trump administration, and that being a stated policy. And that will eventually cause the dollar to continue to weaken. Other currencies are the beneficiary, but as those countries start to spend more, we're going to see borrowing costs in the middle and long end of those curves go up. We certainly saw that in bunds earlier in the week, and I think we're going to see more of that as we go forward throughout the year.
Fascinating, isn't it? Dollar now set for a weekly drop of about 3% against a basket of currencies. Alex, thank you very much for joining us this morning. Alex Morris with us, the CIO at FM Investments. Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.